hopefully. There we go. So we're now recording. So welcome to what is the third Reading online sport economics seminar event. We've had two so far, and the third one we're delighted to be able to have Stefan Szymanski presenting to us from the US. Stefan is Professor of Sport Management at the University of Michigan. He's a world-renowned sport economist and has done all sorts of work throughout his career. He's perhaps well known outside of academia for his book Soccernomics, but throughout he's worked on issues that are really at the forefront, not just for us that may be esoteric issues as economists, but more broadly issues that matter much more widely than that. So racial discrimination, one of his famous papers from many years ago, and worked more recently on footballer pay, and of course at the moment on football club insolvency. So it's a delight to have Stefan taking part. I don't want to take up too much more time as the host of the seminar. I'm going to chair it. If you're joining in, please do make sure your microphone is muted. That'll be really helpful. And I'll chair the session. I'll be keeping an eye on the chat room. So if there are any questions that you've got, please write them in there first, and then I'll have a bit of a look and check and decide if it's something that we should stop the seminar for to ask Stefan a question. He's happy to take questions at any point, be they clarification or be they more substantive. So without any further ado, I'll hand over to Stefan and say thank you again, Stefan, for being part of this session and being willing to present your work. We're really looking forward to it, and the floor is yours, the virtual floor.
Thank you very much, James, and it's a pleasure to be presenting to you today. And I'd like to congratulate you on coming up with this idea of the virtual seminar. I think you're one of the first off the mark, and this is going to be a great series, and all credit to you for getting this going. Okay, so today I'm talking about the current crisis in football club insolvency, and football club insolvency is an issue that I've actually been working on for the last 10 years or so. So I've spent quite a lot of time thinking about this in relation to the history of insolvency in club football. And so what I'm going to do today really is go through some of that background to sort of fill you in on the whole framework of insolvency and how this happens, talk about the financial position of the English clubs as they went into this crisis, and then talk about how the crisis affects that financial position and what some of the long-term implications are. And I probably won't surprise anybody to hear that one of my conclusions is that there are very substantial systemic risks which football faces today, and so I want to conclude with what I would suggest is the kind of solution that we should be thinking about to deal with this crisis. Okay, so I should apologize, particularly for those who aren't necessarily fascinated by everything English, that my focus is largely going to be on England, and the reason for that is partly because insolvency law, bankruptcy law, is something that is very specific to particular nations. So every country has their own system for dealing with insolvency, and as a result, it's hard to generalize if you want to think through in detail how insolvency works. And so I'm going to focus largely on England, but this is a subject which really, I think, deserves study in every country where there are substantial numbers of professional football clubs. Let me start off by talking about how insolvency in general works in England. So first, a little bit of terminology. In England, what bankruptcy is something that we talk about in relation to people, real people, physical persons like James and myself. And insolvency is what we talk about when we're dealing with companies. Now, it's not true. So when we talk about, people are perhaps more familiar with the word bankruptcy, but insolvency really has the same kind of meaning. It's just that it's the term in English law that applies to limited liability companies. So insolvency is defined as a situation broadly where a company is unable to pay its debts. And there are really two ways to think about this. So firstly, you actually owe somebody some money right now, and it's due for payment and you can't pay them. And that's sometimes called cash flow insolvency. But there's also the situation that can exist where you may not have a debt you have to pay today, but you know that the assets that you own are not going to be sufficient to cover the debts that you owe, the liabilities that you have. And so at that point, you are also insolvent, even though you technically don't have any money to pay right now. And that's sometimes called balance sheet insolvency. So the law on insolvency has changed in England, as it has really across the world. And it used to be the case that when you were insolvent, essentially the creditors, the people who you owed money to, would take you to court, and the court would have your company wound up and the assets sold and the company liquidated, so it would no longer exist. And in the 70s, it was realized, first in the United States, that this was really destroying viable businesses that might have a shortfall temporarily, but were actually viable long-term businesses. And so starting in America, bankruptcy law started to change, insolvency law started to change, and those changes came to England in 1985, and this allowed, created a situation where you could bring in what's called an administrator, and people who follow football in England are familiar with the term administration. So an administrator is essentially a professional, an independent professional who's brought in to try to find a way to meet as many of the debts of the company as possible, whilst maintaining the company as a viable long-term business. And administration has been a popular method for trying to preserve companies. A related situation is created with what's called a creditor voluntary arrangement, a CVA. In those cases, the company itself undertakes to organize a deal with the creditors to write off some of the debts, and CVAs have become increasingly common as well. So again, just for be clear on the details, that what triggers an insolvency? Well, one thing that can happen is that the company directors themselves, the people responsible for running the company, they may realize that the company is insolvent, either because they can't pay a debt today or because they know they will not be able to pay a debt in some point in the future. And at that point, it's a legal obligation for the company directors to start insolvency proceedings. So they're meant to recognize this themselves and start to take action to meet as much of the debts owed to the creditors as possible. Of course, that's putting a lot of burden on the directors of a company, who are usually pretty committed to the company's survival. So you can't, and creditors will often not rely on this. So the creditors themselves, the people who are owed money by the business, can petition the courts to start the insolvency proceedings. And that's in practice how a lot of insolvencies really start. So what happens with the outcome? What's the outcome of the insolvency process? Well, in fact, for most businesses, and I'm not talking about football now, I'm talking about football businesses in general, in most businesses going into insolvency are just liquidated. The assets are sold and the company is shut down. So football clubs are unusual in this respect, in that most of the clubs actually survive the insolvency process. And there's two aspects to that. So one is that a football club is more than a limited company. In fact, the limited company owns the football club, but the football club has an if you like, an independent existence. So even if the business that owns the football club disappears, the club itself can survive and essentially come under the ownership of a new company. Alternatively, in fact, in many insolvencies, the company itself actually survives. So because of the arrangement that's made, because the business is not liquidated, then the company can continue to own the football club with having written off a significant fraction of the debts. So here's a graph which shows you for the UK as a whole the insolvency rate. So the percentage of active businesses that become insolvent in any one year. And this is going back to the 1980s. The insolvency rate itself is the orange line, and you can see the number of insolvencies there. Typically, the blue line is the number of active companies, and you can see that in the UK, the number of active companies has increased substantially. That's the left-hand scale, and it's gone from just around 250,000 active businesses to now close to 1 million active businesses. But the insolvency rate for those businesses has really fluctuated around something like 2% for most of the last 30 years. It's also important to note that whilst we're talking about insolvency, a business might shut itself down without actually going through a formal insolvency process. Particularly the owners of the business might just decide they've had enough and just shut down the business without actually going through formal insolvency proceedings. Of course, that's very unlikely to be the case when we look at football clubs, which are where obviously there are huge numbers of people who have a considerable interest in ensuring that the football club survives. So looking at insolvency in England, this chart tells you something about makes a point about the causes of insolvency or what's driving insolvency. And one thing that people often think with insolvency and bankruptcy is that it's got a lot to do with bad times, with declining businesses and industries. And this chart really flatly contradicts that perception. So the red line is the total attendance in English football, professional football, going from 1947 to 2010. And you can see there are basically two eras. There's the period up to 1986, where there's a more or less constant decline. And there's a period since 1986, where there's been a more or less constant increase. And what the blue bars are insolvencies of football clubs. And what you can see is in the era of decline, there were very few. And since the recovery, since the growth of football, there have been an increasing number of insolvencies. So insolvency is not necessarily a consequence of adverse economic conditions. So what does lead to insolvency? Well, we have we have sort of two basic lines in the literature, which really come from two different fields of research. So one is the accounting literature and the other is the economics literature. So the accounting literature goes back to a guy called Altman in 1986, who wrote a paper about how to predict insolvency using accounting ratios. And I've listed there the 5 ratios which are considered the key ones for predicting insolvency. And basically, the way this was done was by matching samples of businesses which became insolvent and which didn't, and businesses of comparable, matching on the basis of comparable size and similar industries, and then looking at and generating a Z score for the likelihood of insolvency based on these ratios. And Altman found that these ratios were typically good predictors, and these are widely used. These models, and that they've been refined over the years, but these models are widely used in business by potential lenders in order to assess the probability that a business might become insolvent. In the economics literature, there's been relatively little said, in fact, about insolvency. The economics literature is more focused on the concept of firm exit, so a business leaving an industry without going into the question of why it left or how it left that industry. But the basic theory behind the exit of firms from industries is to do with uncertainty and idiosyncratic shocks. So going back to the work of Jovanovic and Hopenhain, for example, Ericsson and Paikes, they looked at the idea that firms don't know their true productivity, it's uncertain, but they form beliefs about their productivity based on events, and that shocks lead the businesses to believe that they may no longer be viable, and therefore they exit an industry. So once these random shocks, negative shocks, can cause exit from industries. So I want to say something a little something about the creditors before we go forward, because the creditors are clearly significant in terms of driving the insolvency process, and particularly thinking about there's a peculiar situation in England relating to what are called football creditors. And these football creditors are defined as either players or other clubs that are owed transfer fees. And football creditors have priority in an insolvency. So you can imagine in an insolvency, there are lots of people lining up to collect money that they are owed, or get as much of the money they're owed as possible. And what becomes really important in that situation is priority. Who gets the first opportunity to get repaid? And much to the irritation of the tax authorities in the UK, it's been determined that the players and the clubs owed transfer fees have priority, so they can claim their debts ahead of anybody else. Other creditors can be secured or unsecured. So secured creditors, again, I'm not going to go into a lot of detail about this. There's much more to this than I'm going to discuss here. But essentially, the key point about secured and unsecured creditors is that the secured creditors rank above the unsecured creditors, and that means that being an unsecured creditor makes it unlikely that you'll see much money at the end of the insolvency process. So in general, a lot of insolvency proceedings start with banks being the major creditors to many forms of business, and therefore they're the ones who start the insolvency process. They're usually secured creditors as well, and they aim to get back as much of the money as they can. Now, interestingly, that doesn't really apply to football very much, because most banks gave up lending to football clubs by the 1980s, simply because they were too risky. They were never getting their money back. So you see surprisingly little bank debt on the books of football clubs, and indeed very little commercial debt in general on the books of the football clubs. And usually, one of the largest creditors of a football club is actually HMRC, the tax authority, and they are typically owed taxes which are paid in arrears. These taxes are VAT and the social security taxes associated with employment, and it's over recent years the most likely way in which a club is forced to insolvency is because HMRC pushes for repayment of their debt and demands insolvency proceedings start if their debts cannot be paid. So just to say something about the extent of football club insolvency, and as I mentioned at the beginning, this is something I've been researching for several years now, and One thing that people often think is that there are big differences between countries, and particularly fans and journalists in England got it into their heads that it's far worse in England than anywhere else. And one of the things I've done with my colleagues, Daniel Weimar and Nicolas Sell, is to look at insolvency rates in football clubs in Germany and France. And actually, it's incredibly similar. And the pattern here, you can see here the tiers of in each system, the first, second, third, fourth, fifth tiers. And you can see essentially the pattern of insolvency is clubs in the top tier almost never become insolvent. It's extremely rare. Clubs in the second tier, rare in Germany, but not that uncommon in England and France. Clubs in the third tier, very common in Germany, England and France. Clubs in the fourth and fifth tier, likewise, very common in Germany, fairly common in England. We didn't actually have data. We weren't actually able to get data for the fourth and fifth levels in France, but my guess is it's not so very different. And of course, this is particularly interesting since people often claim that, particularly in the case of Germany, but also France to some extent, that the licensing schemes in those countries protect against bankruptcy and insolvency. And this data seems to suggest that that's not the case. Oh, just to say, if you want, sorry,
Stefan, interrupt you for a moment. Dennis Coates asks, do leagues or the FA impose limits on borrowing for football clubs, as is common for sports clubs in North American leagues?
No. Let's historically no. Since the advent of financial fair play, there have been some financial restrictions that have been introduced, and this is the case for not just at the UEFA level, so there's the UEFA financial fair play schemes, but the leagues have also introduced their own equivalents of financial fair play, which have placed some restrictions on the way in which the clubs are financed. But borrowing limits have not been in place, have not been imposed. But again, bear in mind that certainly in England, football clubs just can't borrow commercially. Even if they want to, it's really not feasible for them to do so, because the lenders know, commercial lenders know how risky football is, and they're just not prepared to do it. And I'll come on to the source of loans in football clubs in a little bit. Okay. So, I just wanted to say as well, if you want to read these articles, particularly the article I wrote in the Scottish Journal of Political Economy really goes into much more detail about how this process works and some of the history, and then the articles on the French and the German case, you can get those from the our Soconomics website here at the bottom if you're interested. So, what causes football club insolvency? It's of course it's been a major topic of debate in the football world, and it's been a major topic of debate amongst sports economists, particularly in Europe, of course, where it's so prevalent. So UEFA and many people in football have taken the view that it's really moral and intellectual failings that drive insolvency, so irrationality and indiscipline. There's another strain of argument, which is Vladimir Andreev and Rasmus Storm and others have been developing over recent years, which is the idea of the soft budget constraints. So drawing an analogy with the soft budget constraints of the former communist systems in Hungary and other countries where this theory was first developed, and trying to apply it to football clubs. Whereas my theory, as articulated in my paper in the Scottish Journal of Political Economy, is that really it's the adverse shocks associated with relegation. And of course, you won't be surprised to see that I'm trying to locate my theory within the economics literature, which talks about adverse shocks. And the wrinkle with professional soccer, professional football in Europe, is that the relegation risk makes the impact of any adverse shock particularly damaging. Now, these three sort of approaches are not necessarily mutually exclusive, and I'm not going to go in today into my critiques of the other two. I don't agree with them, I have to say, but it's possible that all three could be present to some degree. That's a topic for debate on another day, perhaps. But here's just to give you an example of how I see this process working in the idea of adverse shock. Here's an adverse shock. In March 2002, ITV Digital, a broadcaster that had bought the rights to English Football League club games, went into administration itself, owing £200 million to the Football League clubs. The Football League clubs had not anticipated that they would not get this money. It's a long story as to why they thought they would have got the money, but they did think they were going to get the money, and they had a rude awakening when they realized they would not get the money. And here you have a list of what I think is about 17 clubs which went into insolvency in the following year and a half. So the sudden loss of revenues that they had expected put them in a situation where they were essentially insolvent, unable to pay their debts, and hence they went into administration. And the relegations effect here is illustrated in this chart. What you can see here is the league rank of a team within the English Football League system of 92 clubs in the years running up to an insolvency event. So the vertical blue line is an insolvency event, and what you can see here is in the 5 years running up to an insolvency, the average club drops about 16 places. That's in most cases going to be sufficient to cause relegation. And what relegation does is it deprives clubs of revenues. Revenues fall significantly as you go from one division down to a lower division, and your wage costs and your general expenses do not fall as fast, and that's what leads you to being in a situation of insolvency. That said, the actual insolvency rate amongst football clubs is not so terrible if we compare it to the economy as a whole. So you can see here my graph of the UK insolvency rate and the insolvency rate amongst the football clubs in the 92 out of the 92 professional clubs. In fact, this would look even more favorable to football if you included all the lower tier clubs as well, because insolvency rates, although there's insolvency in the lower divisions, there's many more clubs. So when people say how badly football is run, my view of that is, well, you should only really say that if you think that all business is very badly run, and in fact, generally business is much less run than football, which may be true, but I think that caveat is seldom attached. You can also note in the football club insolvency rate, you can see the spike there, and that's the ITV Digital shock actually playing out. Okay, but when insolvencies actually happen, it's important to point out that insolvencies are very, very messy events. So typically in any business, there are many, many creditors, many of whom are very small businesses. Insolvency costs are extremely high. There's a lot of cost of administering an insolvency. And in the end, most creditors receive only a very small percentage of what they're owed. And it's not unusual for this to force insolvency of those businesses in their turn. So there's a problem of potential problem of contagion here with insolvencies, which obviously is an issue we're going to think about in the current case in a minute or two. So I just wanted to share with you this. This is actually, so again, you can download these documents from the government website. All insolvency information of limited companies is available online. in the UK. And so this is actually Bolton Wanderers, who HMRC were owed money by Bolton, and they didn't think they would get it back, so they decided to petition to wind up the club in January of last year. And the club tried to negotiate with HMRC but couldn't reach an agreement, and so they went into administration. And here's something that the administrator produced. The administrator has to produce a report which is available to the public, listing all the amounts of money owed. So on the left-hand side there, you can see just a sample of some of the debts, some of the creditors, and you can see there's small and medium-sized sums of money there. There are 6 more pages of that which are in small, which I've reduced on the right-hand side of the table, which you can see there's a lot of money owed to lots of different people. So you can see just how messy an insolvency really is. You can see here that, in fact, there are 294 creditors. There were 294 creditors at this point in time in general. And then you can see there the secured creditors who were owed, who would rank above all of those unsecured creditors. All those other people were unsecured creditors. And you can see here in the list, I've just picked out HMRC. As an unsecured creditor, you could see they were owed money for PAYE and NI. That's those are social security taxes associated with wage payments with employees, and then VAT, the sales tax debt owed to HMRC. What happened in the Bolton case was the administrator arranged for the assets of Bolton to be sold to a new company, which was partly financed by Pink Floyd's drummer Nick Mason. And that happened in August last year. And so the club was able to play this current season, of course, up until the suspension, in League One. And the old company that owned the club is now in the process of being liquidated. So here you can see an example of how this is one example where the club survived by the transfer of ownership from the old company to a new company. Okay, so now I want to say something about the financial position of the clubs before the crisis, because that's crucial to understand when we think about how we might deal with the present crisis. So you can get all of this data that I'm going to show you in a minute for yourself. And I always like to point this out because, well, I don't necessarily think you should believe me. I think you should go and check for yourself if you're not sure about something. So you can go to this website and you can search the register for the name of any company. And here is my club, Scunthorpe United. And Scunthorpe United's number is 123622, and you can just type that number into the search box and it will come up with all of the filing history of the club. And this includes the financial statements, the annual financial statements of the club, going back 20 years or more. In fact, you can go, if you really want, you can get them to provide you with data going back to 1904, actually, but you can go back as far as that if you want. But you can certainly get all the recent information, but it's not just financial statements. You can get any kind of information that relates to the operation of the business this way, that they have a legal obligation to supply. So, for example, the pages I just showed you from Bolton's administration, they were also found from searching the register and just downloading those files. And you can download all of these files as PDFs. So, and of course, the trouble in all of this is figuring out what the club's identity is. So, and partly because the names of the companies don't necessarily match the names of the clubs. So, for example, the company that ultimately owns and provides financial statements for Manchester United is actually called Red Football. So you wouldn't guess that if you didn't know. But of course, these club businesses have numbers. So here I've done it for you. So if you're interested, here are all the company numbers for the clubs, the 92 clubs in the 4 divisions currently. So you could go and download those for yourself now if you're interested. So where is it? Sheffield Wednesday 2509978, and the full report and accounts are up for you right now. You can see here that, in fact, this was, I did this search earlier this week, so this is on April 13th. Most of the clubs have now reported their financial statements, but not all have. There will be delays. Some will be reporting quite soon. Some may be very slow to report. They will have a legal requirement to do this, but that's not all, that requirement is not always enforced fully. You can also see that there are clubs that say there's full and abbreviated. So there are exemptions for clubs which are particularly small in terms of their business operation, and they don't have to provide full statements. And then you can see there's a couple of clubs which don't have financial statements, Bolton and Bury, which Bury is the other club that became insolvent in the last year. And so you won't find a financial statement for an insolvent business, not a current financial statement either. Anyway. So here's what you're looking at when you download these statements. So again, I've obviously taken Scunthorpe as my example. Particularly being a smaller club, the financial statements are pretty easy to read. You have 2 key statements. One is the profit and loss account, which would be called the net income statement in the US. And then you have the balance sheet, which would be the statement of net position in the United States. These 2 statements will tell you most of what you want to know about the current financial position of a business. So the profit and loss account will tell you basically the revenues of the business, the major sources of costs, and ultimately whether there is a profit being made by the business, whether it's profitable or not. Some key numbers that you want are actually not to be found directly on the statement, but are included in notes to the statement. And one thing that all clubs, all businesses must provide is a statement of how much money they're paying out in wages. So you can find out the wage bill of the club here, and other the depreciation and amortization of the club will also be mentioned in the notes. Likewise, when we look at the balance sheet, this tells us what the business owns, its assets, and what it owes, its liabilities, and the net difference between assets and liabilities is the equity owned in the business. Although, in fact, in this case, in Scunthorpe, you can see that the net liabilities, the difference between assets owned and liabilities owed, is actually negative. They owe more than they own, and so the shareholders have a negative value there. There's a negative value attributable to them. Some other key numbers that you will have to find in the notes, but you will be able to find in the notes, are tax liabilities, what you owe to HMRC, deferred revenues, which I'm going to talk about, and the extent of commercial and bank debt. Although, again, when you go through these statements, you'll find there's virtually no commercial debt, no bank debt on any of these balance sheets. Okay, so just to summarize here, for last season, I have the financial statements for 58 of the 92 clubs in full, so nearly 2/3. About 15 of the clubs, exactly 15 of the clubs, have abbreviated accounts. So again, abbreviated accounts, I've given the definition below. Basically, if your turnover, your revenue is below a certain limit, and your assets are below a certain value, then you don't have to file full accounts. And what that means is you don't have to file the profit and loss account. You still have to file a balance sheet. So it will tell you your assets and liabilities, but it won't tell you what your revenues and costs and profits are. So that gives you some limited information. 17 of the clubs are not yet reported, and then we have the 2 insolvent clubs in the data. One thing to bear in mind is when I say 2018-19, for a financial statement, there is a specific period which must be defined. Most clubs have a year that ends on the 30th of June. All of them during the summer at some point, so between the seasons. So effectively, conveniently, you can see a full season's data in one financial statement. These statements start being published on the Companies House website more or less from November time onwards. So so there's a lag between the year end and the actual publication of the statement. But that's still pretty useful for analyzing the financial position. So here I've aggregated together for each of the divisions the data. And so what you can see is up here, I've got 18 Premier League clubs in the data, 20 Championship clubs out of the 24, 12 League One clubs out of the 24, and 8 League Two clubs out of the 24. So it gets patchier as you go down the divisions. And here I've lined this up with revenue data, the revenues coming in, and then below here the major cost data, which are wages, and then I've got something called EBITDA, which is a measure of profitability. So you can see here as you go down the divisions, the revenue gaps are quite extraordinary. So you've got something like 6 or 7 or times the revenue in the Premier League that you have in the Championship. If you scale this up, because we've got a relatively small sample, you'd still probably have about 5 or 6 times the revenue in the Championship than you have in League One. And Leagues One and League Two actually are not that different in terms of their scale. Notice, of course, that TV money is mostly located in the Premier League. There's a bit in the Championship, but that's mostly parachute money coming from the Premier League to teams that were relegated. And there's basically no TV money in Leagues One and Leagues Two. Likewise, the match day income, you can see the match day income is pretty big in the Premier League, but once you get down to League Two, it's fairly negligible. And you can see here that wages, these are wages paid out, but these are wages plus the Social Security payments that go with them. And you can see that these payments are in the Premier League, it's well over 50% of the total. In the Championship, the actual wages and Social Security payments are larger than the revenues of the clubs in the first place. And in the Leagues One and Leagues Two, they're pretty close to covering all of the revenues. And so you can see from that these businesses are unlikely to be very profitable. Here is interest payable on commercial debt, and you can see here that for given the size of the Premier League revenues, the commercial debt payments are negligible. And again, there's almost nothing in the Championship, League One and League Two, because no commercial lenders will lend to these businesses to begin with. So EBITDA is a very popular measure of profitability these days among financial analysts. Basically, you take the earnings before interest and taxes, and then you add back the depreciation and amortization on assets to get the value. So depreciation is basically the charge added, fictional charge added by accountants to write down the value of an asset over its life. Amortization is a fictional value like depreciation applied to a fixed asset that is intangible, which is an intangible fixed asset is something like a contract. And football clubs have a lot of intangible fixed assets in the form of player contracts. So amortization is a very big deal for football clubs. So EBITDA, and so what EBITDA does is it really, regardless of who owns the business, regardless of ownership, it's basically asking the question, is this business capable of covering its costs? And so the message here is that the EBITDA in the Premier League is pretty substantial. So one way or another, the Premier League was able to cover its costs. But EBITDA in the Championship, League One, League Two is significantly negative, suggesting that even before the crisis, these businesses were, in some sense, insolvent. So here's the balance sheet data for all of these teams. And again, so balance sheet shows you assets. I've shown the assets at the top here and the liabilities at the bottom. So the assets, the major asset of a Premier League club are its intangible fixed assets. Which means the value of its player contracts. And you can see here that in the total assets of the business, then that amounts to what, something like 40% of the total value of the assets owned by the businesses. The other fixed asset of a club is its stadium, and then there are these amounts, debtors and cash, which actually looks fairly substantial. But one thing to say about this is why these amounts, debtors are sums of money that are owed to you. So a large fraction of debtors are likely to be transfer fees that you are owed from other clubs. Most clubs, when they report their accounts, also have a large amount of cash. The reason for this is that the financial statements, if you think they're completing their financial statements in mid-year, they've sold season tickets for the next season already. So people have given them cash, and that cash is reflected on the balance sheet. That's also what's referred to, it's also matched as a liability, which is called deferred income. It's money that has been paid for you, but you haven't delivered the service, and you haven't delivered the service because you haven't played the games yet in the case of football clubs. So you can see, though, when you go down below the Premier League, however, you can see that in the Championship, the intangible fixed assets are a somewhat smaller fraction of the total value. And when you get down to League One and League Two, intangible fixed assets are pretty small. So it's important to note that you have player contracts which are hugely valuable at the top of the system, but as you go down the system, the player contracts are not that valuable. So these clubs are not sitting on piles of assets which are hugely valuable, because the players playing at these levels are not necessarily going to be very valuable to trade in the transfer system. Okay. And when we come down to the bottom here now, really for a business, we would normally think of a business as solvent if its net assets are positive, and the net assets of the Premier League are very solidly positive. But you can see here that the net assets of the Championship, League One and League Two clubs in aggregate are actually negative. So the value of what they owe is greater than the value of what they own. So in some sense, they are technically insolvent. And if we think about these two solvency tests, so you could think of, if your EBITDA is positive, that's one kind of insolvency test. If your assets are greater than your liabilities, that's another kind of insolvency test. And you can see here that more than half of the clubs would fail solvency on the EBITDA criterion. More than half of the clubs would fail the test on the assets and liabilities criterion. And 3/4 of the clubs fail on at least one of these criteria. And that's just based on the teams for which we had data. And one point to bear in mind here is that if we had the full data for all 92 clubs, the situation is probably worse. The clubs that are slow to report, the clubs that file abbreviated accounts, these are clubs which are probably not in the best financial position. So I would think that it would be even worse. So that's one of the reasons why I put the combined test, I put it in blue. Essentially, what I'm saying is here, all the clubs are underwater. So really, you should ask a question: how on earth were these football clubs surviving even before we had the current crisis? Well, if banks and commercial lenders were propping up football clubs, we would have seen most of them wound up by now. They would have been calling in their debts because the clubs were bankrupt. But because there's almost no commercial bank debt in football, this is not actually the problem. Most of the debt, and this goes back to Dennis's point that he raised a little earlier, most of the debt is actually soft debt extended by owners of the clubs themselves. It's soft because if the owners ask for the money back, they're only going to destroy the asset that they own. So what's the point? They're not going to do that. So there's a huge amount of soft debt in football clubs. And of course, the soft debt exists because these owners are getting utility from the prestige of owning a professional soccer club. That's really what this is, what's going on here. They're paying for the pleasure of losing their money and owning these clubs, which is one reason why, uniquely in football, I've never been too particularly worried about debt and insolvency, largely because there's always been a lot of people willing to line up to own these businesses and willing to put their own money in. And if they're willing to put their own money in to entertain the rest of us, well, in my view, that's all well and good. So the insolvencies that do occur, as I mentioned before, really are largely occur when HMRC steps in and it's not getting its money. But in general, HMRC, as you could see from the chart below, from the taxes and liabilities line, it's really only about between something like 2 and 5% of total liabilities of a club. And generally, most clubs can meet that. It's not been a problem to meet those liabilities. And therefore, that's one reason why you haven't seen more insolvencies, even though you might argue that systemically the whole system is technically insolvent. All right, so the problem is that the crisis is changing all of that. So again, in mid-March, the leagues were suspended. Basically, that means that all the clubs have lost most clubs have lost between 4 and 5 of their home games for the season. And that amounts to around 20 to 25% of match day revenues in total. If clubs were to, now some of that revenue had already been received in form of tickets paid by fans. If that money was to be refunded, as most clubs have promised to do, then the total loss for the clubs would amount to something like £150 million. Estimates might vary on that. In March, the Premier League said that if the season were not completed, they'd lose £762 million in terms of broadcast revenues. So that's a fairly big loss there. And there's an estimate of lost commercial revenues of 249 million. This comes from the from @SwissRamble. And if you're not familiar with Swiss Ramble, you should, and you're interested in football finance, you should definitely give this guy a look over. He's a very smart guy who generates huge numbers of financial analyses for clubs, not just in England, but across Europe. And he's very smart. Basically, he's a retired financial analyst who lives in Zurich and decided he had nothing better to do with his time than analyze football clubs. And his Twitter feed is spectacularly informative. So I just wanted to give him a big shout out. So anyway, that total there would be over £1 billion in terms of revenues, and that would be maybe 20% of the 2018-19 revenues, which remember, budgeted revenues would have been even larger than this for the current season. So what would happen if all the clubs lost 20% of their revenues? Well, you start to see things look substantially worse. So notice that the Premier League goes from having positive EBITDA to having negative EBITDA, and things get much worse for the Championship, League One and League Two. So in total, so again, we've just taken £1 billion really out of the EBITDA of the clubs. But then there's the season ticket money. As I said, the season ticket money would normally be coming in now. And what this deferred income is really a free loan that the clubs are giving to the that the fans are giving to their clubs, and clubs have historically planned their finances on the basis that this money would come in, and probably a significant fraction of it is not coming in. It's probably unlikely that everybody is going to be coughing up for their season ticket. That's probably not the biggest priority in people's finances right now. So there's clearly the potential for a shortfall there. And then there's the debtors. I remember I mentioned that a lot of the debtors to clubs are they reflect transfer fees payable. Well, a lot of these clubs may not be able to pay their transfer fee debts. The clubs may not be able to collect on these debtors, and so this may lead to yet a further shortfall. So here I've said, well, what if the clubs lost 20% of their revenue and 25% of their debtors were unable to pay, and there was a 25% reduction in deferred revenues, in other words, season ticket money not being paid. And you can see here, well, essentially, we've now taken about 2 billion out of the system. So the Premier League is now down to minus 800 million in EBITDA. The Championship minus 400. League One and League Two are again relatively small numbers, but relative to the size of the business, that's a pretty substantial number. So you would have to do this. Would require pretty spectacular action in terms of cost cutting and injecting new funds in order to make the businesses viable, in order to save them. But that's not the end of the story either. There's also the intangible fixed assets. Remember those, the assets, the valuation of the player contracts. So these are a very significant part of the balance sheets of the clubs. Player trading, whatever happens, player trading is going to go into decline. And that means the valuation of players, the valuation of these assets will fall. And that means what's called asset impairment. There will need to be a write down on the book value of these assets. So again, that's going to further put stress on the balance sheets because the value of the assets are going to become much, much less than the value of the liabilities. So there's really the threats are really very, very large. Now, mitigation. There are some ways in which these effects can be mitigated. So, for example, when we talk about the match is not played, then there's some reduction in match day costs. You won't have to have many of the costs that you had in terms of people at the stadium or providing services at the stadium, which is so all of that will be a benefit. But it's likely to be limited because most of the costs are fixed in advance. And if you think the major source of revenue is broadcasting, well, the operating cost of broadcasting for the clubs themselves is approximately zero. The broadcaster takes care of that, so the clubs won't be saving any money on that front. Then there's the government. So there's really two aspects to this. One is government bailout. So government bailout, the government's offering furlough pay, 80% of wages up to a maximum of $2,500 a month. And also deferral of taxes, so deferring payment on VAT and property leases. And both of these will be of some benefit, but relatively limited benefit. And particularly the job retention scheme is not really going to be much benefit to the club because they don't employ very many people. This is particularly true, and the people they do employ earn far more than £2,500 a month. And so they won't be eligible for covering 80% of their wages. You'll still have that limit up to 2,500, but it won't be worth very much. And if you work this out, it could make a difference to some of the smaller clubs in Leagues One and Leagues Two. We're talking about maybe £500,000 to £1 million a month, and that could be substantial for those clubs. But it's also, I'm not clear on how long this scheme is going to go on for. I'm not sure if the government's announced exactly how long it will go on for, but a large part of its value would depend on how long it would last. Interestingly, there's also been a temporary change to the insolvency law arising from this. So bear in mind that, remember I talked about when you're insolvent and the directors know, if your directors know when they're insolvent, then they have to declare insolvency. If you don't declare insolvency when you know you're insolvent, then that's called wrongful trading, and that is actually an offence. So the government has actually temporarily amended the law to say that businesses continue even if they know that they're insolvent, which is some relief, at least legally, for the liability of the directors of the company, although it's not clear how far this really solves the underlying economic problem. Of course, mitigation could come from the players. The players could take pay cuts to reduce the losses. Now, the players are under contracts, and these contracts tie them down to their jobs. Unlike the rest of us who can move jobs freely, players can't move like a typical employee. And so part of the benefit of that is that they have an enforceable contract for their wages. So it's not clear how many players are really going to be wild about the idea of giving up the contractual obligations which the clubs owe to them, given that they pay a fairly high price in terms of being tied down to the club in order to get that benefit. And also, one of the problems is, I mean, when we're talking about we talk about, and this is a general problem with unemployment, isn't it? That there are people who are, if they're laid off and they don't get paid, they're not going to be able to pay their mortgages. Well, that could be true for many football players as well, which means that they're not necessarily going to be inclined to negotiate freely with giving up on their wages. And bear in mind also that the players in the lower leagues are on fairly low wages to begin with. They're not in the kind of Premier League category of several £1,000s a week. You know, it's not a particularly high-paid employment in the lower leagues. So I'm not sure that mitigation's going to do a lot here, but I want to talk about some of the longer-term risks, which I think are very which go even beyond what we've talked about here. So if the league were able to reopen soon, then you could recover some of the losses, particularly if you could play games behind closed doors. But I must say I'm skeptical about how plausible this is going to be. The UK is going to be in lockdown at least until mid-May, and it might be more like June. And even if you were to play behind closed doors, they're still going to amount to a gathering of a fairly substantial number of people in the same place. And it's not clear to me that the government's going to permit those kind of gatherings to take place. It's possible that there's some brief window in July to do this. But if you don't do that, you start to creep into next season, and then the possibility of disrupting the following season. Because of the threat of a second surge of the virus, it seems very unlikely that crowds of as big as 10,000 people, or maybe even a few thousand, is going to be possible much before we find a vaccine for this, and who knows when that's going to be. And even when that happens, it's quite likely that a lot of fans are going to be reluctant to go back to large stadiums and be in large crowds. Not everybody, some people will go back, but there's going to be a consequence for this. And if playing games without a crowd is something that's going to be a fixture for the future, then it's very uncertain as to what the value of that is, whether those rights values of the broadcast rights will hold up. It seems likely that those rights values will fall to some extent. And really, there's a significant systemic risk here in the which is introduced by these by the problems of the debts that are owed. So many of these debts are between the clubs. Clubs are owed money as debtors on transfer fees, and they have creditors. They owe money to creditors for transfer fees that they have not yet paid. And the problem here is that if the people may be unable to pay their debts, but you may not be able to write off your creditors. So think of this simple example. Suppose I owe you £1 million and you owe me £1 million. So we're both creditors and debtors to each other. And so there's, in some sense, we're in balance. But now suppose neither of us can pay the money we owe. We don't have the unilateral right to write down our creditors. We can't just say, oh, well, we don't owe the money. Technically, we still owe the money. So even if we're not receiving the money we're owed, we still technically owe the money as a liability. So our liabilities remain fixed, but our assets, because we're not getting paid by our debtors, have fallen. And so we're now both insolvent. So that's a kind of weird example of just between two people. But imagine what's really going on here is that these networks exist across football, and there are the danger here is that everybody, nobody can pay, nobody is receiving money from their debtors, and yet the value of their creditors remains fixed, in which case the whole system is insolvent. Now it comes back to the point about there's no commercial debt here. So the so-called sugar daddies have been the subject of much hatred over the last 20, 30 years. But in some sense, they're the insurance scheme here, or at least on a temporary basis. What's been holding up football clubs for a long time are soft loans from the owners. And of course, football clubs are not going to start, banks are not going to start lending to football clubs now. They're not going to change the habits that they've developed over 30 years. Now, the soft loans were always unlikely to be called in. I just gave the example. Roman Abramovich claims on the financial statements of Chelsea, it says that Roman Abramovich is owned £1,167 million. Presumably, he never expects to see that money. But now the problem is that if new money needs to be injected, the rich individuals who have bankrolled football for so long may be squeezed in their other businesses, and that means that they may not be able to inject more money to keep the clubs afloat. So they won't be able to call in their soft loans, but they may not be able to they may not be in a financial position to put more money into the clubs, depending on how their finances are working. And Mark Palios, who was former Football Association CEO and chairman of Tranmere Rovers, talked about double-figure insolvencies. This was just reported yesterday on the BBC, and he has a lot of experience with insolvency in football, given his former position in the FA, and I think he's not wrong. I think that sounds quite likely. Solutions. All right. So, is there a way out of this? Well, maybe, maybe not. It's not clear. I mean, one possibility is the whole thing's going to go to the wall. But I want to try and think about ways in which you might find a way to shore up the businesses. And it's something, again, I'd been thinking about already based on my research on insolvency. So I wrote an article in the FT last year where I proposed that what's really required is an insurance fund against insolvency threat. So I described a scheme in there which I thought could work. Again, all the economists in the room are shouting now moral hazard at their microphone. But there are ways to address the moral hazard issue, and that's what I was thinking about. But basically, this is a way to the idea is that clubs would pay in a certain amount of money out of their revenue, and then if they fall into insolvency because of an adverse shock and relegation, then they would be able to draw against this fund in order to survive. Now, I still think this is a good idea, but this is not going to solve the problem that we face today, because it's more of it's a systemic threat we're looking at, and that's the problem we have to face up to. So my view is that when you think about the system is under attack, what you need to do is to consolidate the system. And that's particularly because they've got this network of clubs, each independently owing each other money. The net indebtedness of the system is much smaller. And so if there's a way to consolidate the debt across all the clubs into one pot, then you have the possibility of reducing the systemic threat. Likewise, when we come to the players, the players have always been reluctant to take part in insolvency rescues because of the football creditor rule, which gave them priority in insolvency. So they could just hold out for the money that they were owed without having to worry about getting paid. But now that the entire system is threatened with collapse, then that no longer looks like quite such an attractive route, and therefore the players have an incentive to come to the table to negotiate over their liabilities of the clubs to them through contracted wages. But my view about this is that you can't impose this unilaterally on the players. You have to engage the players in a negotiation, and in some sense, in order for the players to agree to this, there has to be some kind of quid pro quo. There has to be a give and take on both sides in order to preserve the system. So what I would suggest is something that would look like this. You would create a consolidation fund. Now, you could imagine doing this for England on its own, but you could imagine this being a European-wide operation led by UEFA. In some ways, the broader the scheme, probably the better it is for football in the long run. So how would this work? Well, the consolidation fund has to have some asset of its own in order to form a basis for its own economic activities. And what I would say is assign all future broadcast rights to the fund, all future football broadcast rights. So again, if it was England, all future broadcast rights in England, or Europe, all future broadcast rights across all leagues and all competitions across Europe. And again, it wouldn't include existing contracts. So any contract that's already been signed, that would not be included in the scheme, because the clubs would already be counting those as assets on their balance sheet. So you don't want to take those away, because that just adds to the problem. But future broadcast rights have value. And even though it's likely that future broadcast rights are going to be less valuable in the future than they are today, at least in the short term, they still will have significant value. So the annual value of Premier League broadcast rights and the contracts they've just signed are worth around £3 billion a year. Even if you thought that would be halved, you'd still have an asset of very significant value for the contracts that they were the broadcast contracts 3 years from now. And even with discounting, they would be of significant value. So then what you would do is essentially the scheme would take up all assets and liabilities in relation to transfer fees and unpaid wages. So by consolidating in this way, the net debt would be relatively small, and the consolidation fund would hand out claims to all of the clubs against those, which would be redeemable at some point in the future, say 5 years from now. They could then, likewise, the players could negotiate with the fund to receive a credit for unpaid wages, which would be redeemable at some point in the future out of the consolidation fund revenues. So basically what I'm saying here is create a scheme whereby you can use the value of football in the future to save the football system today. Again, that's asking future generations to pay for this, but then future generations won't have the football system that we know now if they don't pay for it through a scheme of this kind. So I think, although in general I'm not necessarily in favor of borrowing against future generations, in this case it seems to me that there's a good case to do this. Now, I think some people have compared the current situation to wartime, and in particular there was an article I think it was in Soccer and Society or Sport and Society came out this week comparing the current crisis to the organisation of football during the Second World War in England, which effectively there are some similarities where effectively the government militarized the football system and basically told football clubs what they would do, who would play games, who would not play games, which players would be available, and so forth, in order to preserve wartime football to some extent as a form of entertainment, without whilst maintaining the war effort. Well, this is, in my mind, this is sort of not dissimilar. It's not quite the same thing, but it's a similar idea of centralized consolidation as a mechanism to ensure long-term survival. Now, how this scheme would be managed is something that would require quite a lot of negotiation. But my point, the point I would suggest is that this should involve joint representation of players and clubs. So this should be a joint effort and effectively would introduce a system of collective bargaining into the organisation of football. The scheme would, because it owned assets that were valuable, it would have the potential to raise money, and potentially the money to raise money from banks, because the banks would look more favourably on something on football as a collective organisation than it does on individual clubs. And the scheme could then pay out money to individuals based on hardship and need, both to individuals and to clubs based on hardship and need, in order to ensure their survival. So in that sense, the scheme would have to work in the interests of everybody who had a stake in the system in order to preserve that system and make it viable. Then hopefully when life returns to normal sometime in the next few years, you could unwind the schemes. And of course, how it would be unwound would be a matter for immense discussion and negotiation, and it would be, the devil would be in the detail. But you could think of unwinding the scheme at some point once we have something like a normal system in operation. But one thing that you would leave behind in all of this is my insolvency insurance fund, which would still, because once we get back to normal, we'll go back to the pattern we've seen historically, which is occasional insolvency of football clubs, which in my view is about adverse shocks and relegation. So that's my proposal. It's obviously a work in progress and something that I want to think about in the future, and would be very happy to have comments and thoughts from people either now or later. So thank you very much for your attention.
Okay, thank you, Stefan. There's been a few remarks as we've gone along that we've parked to the end, so I'll just quickly check back through the chat. One of the questions was a question for clarification, which was that major source of revenue for clubs in the Premier League and Championship is commercial income. So Man United, apparently their commercial income is 44%, and that wasn't included in the revenue. Is that right? In your tables earlier on?
It wasn't broken out separately. So one of the problems is that the the way clubs report their breakdown of revenues varies quite a lot between the accounts. So if you want to come up with an aggregate number, it's not easy. It's not easy to do that. But it's quite right. I mean, commercial that commercial revenue was in the headline number, the top number for revenues. I just hadn't broken it out separately. But if you went through the club accounts, and you could extract all of those individual numbers if you wanted to.
Okay. And then Linda Arch says that the job retention scheme that you mentioned is going to last at least in its current form until the end of June. So that gives some sense.
Yeah, which is not very long, right? And
no.
It's a very limited. I mean, as I say, I think it will be of value to League One and League Two clubs, but I'm not sure it's how. In addressing the insolvency crisis, I doubt it's of much value to Premier League clubs or Championship clubs.
Yeah. And then another question, kind of related, is a slightly bigger picture, is the legal standing that clubs have to sue if they, for example, were relegated without the full season being completed. Can clubs sue each other in the high courts, for example?
The rules of the national associations and UEFA and FIFA state that you must settle all disputes in the football family through the associations and ultimately the Court of Arbitration for Sport. That said, it's not clear that it's legally that they have legal standing to tell people they can't go to court. So in practice, I think they could go to court. It was certainly in theory they could go to court. In practice, they might not, because that could lead to further sanctions against them.
Yeah. Then I guess another slightly related question, which you've perhaps covered there a little bit, is to do with the financial fair play. And you mentioned these soft loans, rather than bank loans that most clubs rely on. And presumably that's kind of within this footballing family, kind of football creditors come first kind of principle. Would that be the case, or?
Sorry, how do you mean?
So the question is, the financial fair play laws, that are in place in terms of debts incurred. How do they stand when it comes to these soft loans from club owners, for example?
Well, the financial fair play rules are mostly about break even. So it's mostly about the profit and loss account, the revenues and the costs, and not so much about the balance sheet. So in that sense, there's no restriction on soft loans to a business. The question is whether you are paying wages and spending on transfers out of your so-called football revenues, which are match day, broadcast, merchandising and sponsorship, rather than relying on soft loans to finance that.
Yeah. And then a quick question just come in now. With the introduction of collective bargaining, concept more prevalent in North American sport, would this create unintended consequences of introducing more socialist restraints in a traditionally more free market European sporting market?
Well, unintended consequences, there will be very, very many. Whatever we do, there are enormous unintended consequences. I mean, so yes, I think I think collective bargaining would be a good step forward for football in general. I think if we had collective bargaining in football when we came out of this crisis, we would have a more stable and a fairer system. I think players are often, I mean, and this is not necessarily always a popular view with fans, but players in the lower divisions often suffer a lot because they are not treated fairly and they are not given fair bargaining rights, and their ability to seek redress for unfair treatment by clubs is in most cases quite limited. So collective bargaining would help to solve that problem. So and in my way, in one sense, the clubs need the players to reach an agreement, and the players have an incentive to reach an agreement, but the players should ensure that they get some in some sense, what comes out of this is a system that will work more fairly for them, not necessarily in terms of getting them more money, but just getting them a more reliable employment arrangements.
Okay, yeah. And then Adam Gold asks, Premier League clubs could furlough players, right? But their players' earnings would be tiny compared to what they're used to. Is that the main constraint on them doing that, or?
Well, so this would be an interesting case in a court of law. The clubs have a contractual obligation to pay the players. So the contract between a player and the club is not quite the same as the typical employment contract that the rest of us experience. And it goes back to this point. The rest of us can just walk out of our jobs any time and take up another job, which means that also if we're laid off, there's some symmetry there. Players can't do that under contract. They can't just leave a club because they want to. They have to get the agreement of another club and of their club, and indeed, they can't start the process of moving to another club unless they have the agreement of their club until they're out of contract. And so, given that different situation, I think they would also be in a different position when it comes to if the clubs try to abrogate the contracts, they will find themselves being sued and they may be liable for the contractually agreed payments.
Yeah. Thank you. We're running close to the end of our time. Dennis Coates has had to go to his next Zoom meeting, but he asked if collective bargaining is a prerequisite for your proposed scheme.
That's a good question. It's not clear where it's absolutely necessary. I think it's a sensible way to think about it. I think the scheme requires the players to buy into it, which means the players have to be represented. So it's hard. It's hard to make sense of a situation where you say, well, we'll have temporary collective bargaining, but we'll abolish it when we get back to normal. I mean, that could happen, but in any case, the scheme wouldn't necessarily be a form of collective bargaining because it would require a joint agreement between the players and the clubs.
Yeah. Okay, and then Sumit Pandey asks, would it be fair to say soft loans might be getting pumped in through some sort of commercial deals to get revenues of a club? Into the revenues of a club, sorry.
Well, I mean, that's an argument for a different day, I think. I mean, that's an argument about Manchester City and financial fair play and all of that, and whether that's the way in which clubs were being financed. I think the important thing to recognise here is that, Sheikh Mansour is not going to go bankrupt in this situation. He's not going to be under much financial pressure, so he can continue to support Manchester City however he can within the constraints imposed by UEFA and the law. But the point is that dozens and dozens of these football clubs are underwritten from soft loans from individuals who are very wealthy, but nowhere near as wealthy as Sheikh Mansour. And those people are likely to find their finances coming under significant pressure. And therefore, I just think it's unlikely that more soft loans are going to become available, or the scale of soft loans are going to be there in the near future that we've seen in the past. And given the scale of the kind of deficits that these clubs are building up in terms of both revenues and in terms of assets, I think that's the thing we need to focus on, is how to deal with that problem.
Yeah. Couple of final questions. Linda Arch, Stefan, is it correct that most clubs, even the very wealthy ones, have very little by way of retained earnings and general reserves to cover this year's losses?
Well, retained earnings and general reserves are sort of generally sort of fictional numbers anyway. I mean, that just means that you've made a profit in the past. And yes, it's true, they've never really made profits. But the fact is, where is the hard cash to cover the costs that these clubs are liable to pay the debts that they owe, the creditors they owe money to. Where is the money for that, and where will be the money in the future to pay the players whom they need to employ? And that's the real problem we're facing here. It's impossible. There's no business. I mean, football, in that sense, football is like everybody else. All businesses are facing this huge threat of a systemic. This is a systemic crisis, so they face the same problems. Nobody's built up reserves which are sufficient to really get you through this catastrophe. So I don't think, in that sense, football's not very different from anybody else.
Yeah. And do you think there'd be a major fight? Matt Carton asked, do you think there'd be a major fight back from the bigger clubs against the scheme that you're proposing?
Yeah, that's a very good point. And yes, I think there's a danger from that. And I think one should say that there is an alternative scheme here. The alternative scheme here is everybody for themselves, in which case the big clubs might be the ones that end up surviving. All the little clubs go to the wall, and the big clubs have the Super League that they've always been threatening to create. I think that would be a very bad outcome, but I think it's not impossible to see that happening. Is there any way to stop the big clubs behaving like that? Well, the national associations do have some power in relation to this, and also they have a lot of political support. So the governments in Europe would not like to see that kind of situation arise. So again, probably, and I didn't really talk about it in any detail, but this scheme would need to be underwritten by governments as well. And if the governments made it clear to the clubs that this was their expectation, that they should go along with this, then I think the big clubs would find it harder to stay out of it. But it's a good point. It's not necessary. My scheme is one way of dealing with the crisis. It's clearly not the only way.
Yeah. Well, thank you very much, Stefan. The final question is, will the slides be uploaded somewhere, and you're going to put them on your Soconomics blog? Is that right?
That's right. I'll post them up on the Soconomics Agency website. There was a link in one of the slides to one of the pages on the Soconomics Agency, so you can follow that, and you'll find there on that site you'll find it. But also, you're going to post the on YouTube, right? The talk, and so you'll be able to see the link there and see the slides there. Is that right?
Exactly. So within about an hour or so, we'll get this up on YouTube so it can be watched, and the link will be shared on Twitter. You can put it on your website, Stefan, and we'll put it on our University of Reading website as well. So
and we'll both tweet out the links, right?
Yeah, exactly.
Yeah.
So thank you very much, Stefan. It's been really, really interesting, fascinating talk, and let's. I guess we'll look forward to see what the carnage brings us in the next few months and see how things turn out. But thank you very, very much, Stefan. Thank you everyone for taking part as well.
Thank you. Yes, thanks everybody for turning up.
Great. Cheers. Bye-bye.
Bye.